merger with Horizon, but it doesn't stop Rock's shares rising. Digging dirt, Fortescue hits a record run rate for June, but CapEx expectations are lower than previous guidance. Role reversal, the local market stages a turnaround after intra-session losses.
This is Trading Day.
Well, after Wednesday's 31% nosedive, Navitas recovering in part. For more analysis on that one, Fraser MacLeod from Morgan's in Adelaide joining us. Fraser, welcome to you. Inevitably, some are seeing value, but still there are naysayers out there, as you'd be well aware, saying if it could happen with one, it could surely happen with another, by which I'm referring, of course, to the Macquarie Uni contract that was lost at great expense. What, $1 billion wiped off their market cap on Wednesday. How do you see the business?
Look at Navitas, if you're not familiar with the business, the core business is this pathway course for university students, whereby international university students can come across to Australia. Navitas take care of the first year, and then second and third year they pass on the income stream and effectively the student onto the core university here in Australia. It's been a brilliant business over the years, and we've had increasing students coming from abroad. They're attracted by the fact that, well, we have this Western-style high-quality education that a lot of parents wish their children to participate in. The problem is that the Macquarie Uni deal, it ran for 18 years, and Macquarie University has suddenly said, well, gee, the margins that you've been making, perhaps we could make a better job of it and make our own margins out of it. And certainly the Navitas business model is starting to show some cracks. The deal is worth, or the deal loss is worth, was worth around 3,000 students to Navitas per year. Now that you're correct in saying that was worth, say, around about 23% of the EPS on the stock. So is the stock cheap, if that's what you're asking? We would caution that it's probably not at this time, and we feel that other universities perhaps are going to be knocking on the door when contract negotiations come around on royalties, and Navitas is going to be a weak position.
What does it do? Because it sounds like the whole business model could be fatally under threat, heaven forbid. Although when I spoke to the CEO earlier this week, he was adamant that growth was their watchword, he would be pursuing it. And yes, he did acknowledge this was disappointing, but he said it's a one-off. Their circumstances are unique.
I don't know if it is a one-off, and I suppose he would say that. But the challenge is on royalty payments. The negotiations with other universities, at least those other universities, are now going to be in a stronger position. Undoubtedly, that's the case. So we would caution looking at the stock above $5. If it was to get to, say, $4.50, then you could perhaps start to see some value come into play there. But trading on around about 25 times earnings, we would caution on that model going forward. The dependability of the earnings certainly now would be brought into question.
This is interesting. So even though you've said now the dependability of earnings and cracks appear to be forming, you would still be a buyer at further beaten down levels. You wouldn't be saying to clients, sell, look elsewhere.
We were never big holders of Navitas anyway, and when there has been moves like this, then you have to put the slide rule over it and say, well, at what point might it be worthwhile to have a look. I certainly wouldn't be buying at this level. What are they trading at today? They have bounced back and they're now trading above $5, so I wouldn't be looking at them yet.
Yeah, is there any other kind of way that you can be in on the space with someone else? Someone that might be sort of an emerging leader, to use that language?
Sure, look, it's difficult to be able to play pure education providers here in Australia, and we would also caution against paying too much for that education dollar. It's hard to gain good quality listed exposure. Other models that have been fashionable of late, the higher PE models of, say, the car sales or the real estate or the seat. Again, I would be pretty caution. I would show some caution on as well. So it's not a space that I would really wish to be playing in, to be honest.
All right, let's switch sectors. Let's talk Fortescue today. Now, the metrics are well understood, although you're kind of, again, you're fairly cautious on outlook. Why so?
Obviously, Fortescue, everyone knows quite well, and they're incredibly leveraged. The challenge with Fortescue is that whilst the run rate looks to be okay from today's figures, the amount of tonnes that they shipped in the last quarter was 38 million tonnes, there or thereabouts. So the total production was, say, 124 million tonnes over the course of the year. That's slightly below Fortescue's guidance, but you can let them away with that, and it means that the run rate is say, travelling around about 160 million tonnes. That's okay. We don't mind the volume run rate. The challenge that we have is around the price and the discounting that's been achieved from Fortescue. So the average price received was, over the course of the year, was probably only around $106 per tonne. Now, that compares to an average benchmark price over the same period of $124 a tonne. So big discounting from Fortescue, and it means that they have to ship an awful lot more to earn the same dollar. And from that point of view, we are starting to become a bit more cautious. The leverage that's in play on Fortescue means that they are quite sensitive to the price, and certainly the old, there's a lot of premium product around, and if you're not selling a premium product, or a slightly inferior quality product, then, well, gee, the discounting seems to be very, very high, and that perhaps was a surprise to the market. I do think that with Fortescue only down slightly today, perhaps the market as a whole has flattered this news when it's come out, and hasn't really taken the negative impact on the news perhaps as much as it should have done.
Fraser, really briefly, we could one final stock, and that is Orica, which has been on a tear. Today is no exception. I'm just wondering specifically, though, on this, we can pontificate over reasons why, but when is a decision likely to be made on a spin-off of that chemicals business? It seems to me that the consensus is either a trade sale or a spin-off, but they have been looking at this since January, so the clock's ticking.
Yeah, the clock is ticking, but I don't think there's really a need to make any rash decisions within the board level of what to do or whether to split up the company. By all means, the company has been undervalued over the past 6 months, especially, and 2 months ago, when they were trading in the high teens as a price per share, that is very, very cheap if we look back over history. Usually Orica has traded on around about the same PE as the market as a whole, whereas 2 months ago they were trading on a 15% discount to the market. And it has to be remembered that Orica is a fairly defensive business and still a growth business. If you're looking to play global growth through an increase in especially US dollar earners or US earnings as a whole, then Orica's not a bad place to play. And I think the market's really starting to realise that it's probably a better place to play cyclical growth rather than to play resources directly. Orica obviously is more inclined towards the volume delivered rather than the price of resources.
So, just to clarify, you're not calling for some speedy decision, because I was noting that Morningstar back in May was saying, look, if it does exit it's going to clear the decks, it can focus on its core mining service operations, which after all is its bread and butter.
It would, certainly, and the cash flow that's coming in from Orica at the moment, it certainly is its bread and butter. The cash flow that's coming in from Orica, ultimately shareholders are looking for that value to be released, and hopefully that will be the case. But I think Orica would only do a deal on their terms, and so the business is still generating a lot of cash flow. The debt is not a problem. At the moment, there's no need for any hasty sale to come around. So I'd be a buyer still of Orica at current levels, and in our eyes, they're probably worth closer to $25.
It's an interesting story just to ponder the link with the high Australian dollar, because here you are talking North America, so it's on several continents, and it needs to inevitably repatriate those profits homeward. Yeah. At which point it loses out.
At the moment it does, yeah. We would, our feeling on the US dollar is that it's just simply too high, and our feeling on the Aussie dollar is that the US dollar is simply too cheap, and the Aussie dollar is simply too high. So our target on the Aussie dollar for this Christmas is 79 cents, and that's a good 15% move. And gee, Christmas isn't that far away now, is it? We're more than halfway through the year. So Glenn Stevens has said that more than a few times that the exchange rate is doing damage and it should be lower. Every time that Glenn Stevens mentions that, the Aussie dollar drops by 0.5%, and then the next day it seems to regain some ground again. So the problem is one that the US dollar is too low. The US budget deficit has been tightening for a long time now, so there is less US dollars around, and will be less US dollars around. And when the US dollar becomes more scarce, well, gee, the price has to go up against the Aussie dollar. So we are still waiting for that to happen, but we certainly are recommending that clients gain more exposure to US dollars, to overseas earning stocks, stocks like, say, Brambles or Sonic Health or Amcor, Illumina, many stocks that are able to make some dollars abroad that perhaps a lot of investors out there here in Australia have been underweight on over previous years.
And that's extraordinary that you're calling 79 cents against the greenback end of the year.
It's a big call.
That must imply what? That Janet moved sooner than expected.
Well, Janet has pretty much flagged and has pre-announced, what she's going to do with QE, and we all know that interest rates in the US have to go up, and probably at the same time, however, you'll see Glenn Stevens do a fairly similar job as well, and the interest rates will go up here. It's not really a call on, if you look back over history, it's not really a call on interest rates as such that is going to move the Aussie dollar. We feel it's more important to look at the budget deficit in the US, and the fact that the budget deficit certainly has been tightening. The budget deficit in the US is half of what it was just a couple of years ago, and it's a third of what it was 5 years ago. So the budget deficit is no longer a problem. There is certainly less US dollars around, and the price of the US dollar should be going up. Perhaps it is just a gift for Aussie investors at the moment, and perhaps it's a time to get set in while you can before the end of the year in good quality overseas earners.
There you have it. It's your window of opportunity. Thanking you, Fraser. Appreciate it.
Thank you, Dave, for your time.
Fraser MacLeod from Morgans in Adelaide. Well, after the break, the Business Council's on the attack at slamming the idea of policy on the run. We'll get a camera pulse check with our reporter in just a moment.